Ladies and gentlemen, hello and welcome to another episode of the Cautious Trader here. Today we are actually going to go over this idea that was posted by Nugget Trouble. I'm not sure if that's how they want their name pronounced, but it's a very good idea that was posted here on TradingView, and I wanted to take you guys through it. I think it's got a lot of great ideas here. So let's get into it. It's regarding the comparison between the yield provided by US Treasuries versus the overall market. And this is what it says. It says that as the US 10-year yield approaches 1.5%, the same yield as the S&P 500's dividends, this leads to the question, which asset class is safer to guarantee a 1.5% yield? Of course, it's the US Treasuries. The market rally we have seen since April was mainly based on the artificially low rates that were present at the time. Lower rates justified the purchase of growth assets with high valuations. High yields pose corporate credit problems and undercut the present value of future earnings of growth stocks. Higher rates erode the value of future cash flows or for growth companies more than the mature value businesses because growth companies expect to see a large share of their profits come further down the line. So think of all your favorite tech companies that are pretty much losing money right now, but they still have insane evaluations. Why is that? Because uh, it's a bet on future earnings. It says smaller, less profitable growth names are most sensitive because they are largely less profitable at present. The formula for calculating net present value is as such here. The bigger the R, I think they misplaced the R here. The bigger the R or the yield is for every future time period, the larger the decrease in cash flow will be for that time period. A lot of SPACs we have seen come up the last couple of months will get hurt too. Further weakness in bonds could drive rates higher, potentially to 2%. And they've included a link here which we'll take a look at. The results for the 7-year bond auction were horrendous with a record low bid to cover. Then they give examples of Fiverr, Lemonade, Square, and Wayfair. These are all high-flying stocks with extreme valuations. Most of their value comes from optimistic financial projections, higher rate cuts into their estimated revenue, and higher rates cuts into their estimated revenue and makes operating expenses more expensive, reducing profitability. And then he goes on to say he'll be watching these stocks for further downside and confirmation. So let's have a look at the chart that's provided here. And if you take a closer look, it's basically the comparison of these stocks and how overvalued some of them have become to insane levels, some even approaching 2,600%. But of course, as we see the yields on US Treasuries flip, then we also will see a return to more quote-unquote normal levels. And this is the formula that was presented here, and basically that's it. So with that said, since markets have opened, let's jump quickly into checking out some of our favorites. We start with Bitcoin. And on Bitcoin, we saw that we dipped below this 50 candlestick average moving average, but we did not end up closing two red candles below it. There's actually has been a reversal. I'm not sure if this will carry through. Maybe it will get rejected by the EMA ribbons, and in that case, it could head back lower and close below. In any case, we have to wait and see. I will still be not touching this until we test this support area at 41,000. And let's go to our next favorite that we always check out, USDCAD. And here, US dollar has weakened significantly. Uh, Sorry, my bad. The Canadian dollar has weakened significantly. It's really the US dollar which has strengthened, and we've not only broken through this uh, resistance level that we had, but we have successfully closed above it with two green candles. And it's interesting to see whether or not this long-term trend line will provide any resistance um, to our price here, but regardless, there has been quite a big reverse. And then we'll also have a look at gold. And as I mentioned in the last video, gold had seen a big move to the downside. Uh, so it's no surprise that we are seeing a little bit of a bounce. Maybe it will go even as far as the 1775 level before heading back lower, but on the lower side we are looking at the 1695 level. Anyways, thank you so much for your attention today, and we'll catch you in the next episode.